Ladies and gentlemen, welcome to this episode of Market Meridian. I am Eric. On April 15, 2026, local time, the U.S. stock market witnessed a spectacle that will go down in the history of cross-industry transformation. Allbirds, the once popular eco-friendly footwear brand in Silicon Valley, announced that it would completely abandon its decade-long footwear business and fully transition to the field of AI computing infrastructure. Upon the news, its stock price soared by 582% in a single day, closing at $16.99 per share, with its market value surging sevenfold. From a pair of wool sneakers to the hardcore track of AI computing, Allbirds' sharp U-turn, is it a desperate move to break through, or a short-term hype to ride the trend? What market logic and potential risks are hidden behind this 550% stock price carnival? Today, we will deeply dissect this cross-industry event that has shaken the capital market. Host on air, studio, background showing Allbirds stock price trend chart and AI computing related images. Hello everyone, I'm XX, host of Market Meridian. Recently, the popularity of the AI track has been continuing to soar. From policy support to industrial implementation, from capital pursuit to performance fulfillment, AI has become one of the core investment themes in the global capital market. The reason why Allbirds' transformation has triggered such a drastic stock price reaction is essentially the dual resonance of a struggling enterprise plus the AI trend. But we must clearly see that crossing from the consumer sector to the high-tech computing sector is not just about business differences, but also a huge gap in technology, capital, and talent. Today, we will take you to understand the capital logic and industrial truth behind this event from three dimensions: why transform, what to transform into, and can it succeed? To understand Allbirds' transformation, we first need to understand its desperation. Founded in 2015, this eco-friendly footwear brand was once the brightest star in Silicon Valley, co-founded by former professional football player Tim Brown and renewable resources expert Joey Zwillinger, focusing on the core concept of replacing plastic with natural materials. The first wool runner wool sneaker launched in 2016 quickly became the uniform shoe of the Silicon Valley tech circle with its comfortable fit and eco-friendly positioning. Celebrities such as Google co-founder Larry Page and Apple CEO Tim Cook were once its fans. In 2021, Allbirds successfully listed on the U.S. stock market, with a market value once exceeding $4 billion, becoming the first eco-consumer stock. At that time, it was highly anticipated by the market, which believed it would lead the eco-revolution in the consumer sector. But the good times did not last long. Changes in consumer trends, the influx of competitors, and the continuous rise in customer acquisition costs quickly pushed this star enterprise into trouble. As sports brands have successively laid out eco-friendly product lines, Allbirds' differentiated advantage has gradually disappeared. Coupled with a weak consumption recovery after the epidemic and the decline in consumer demand for mid to high-end casual shoes, Allbirds' performance has continued to be under pressure. To save itself, Allbirds has made a series of struggles, closing offline stores, reducing product lines, laying off employees to cut costs, but none of these measures have been able to reverse the downward trend of performance. It was not until March 2026 that Allbirds made a subversive decision, selling its intellectual property and related assets to brand management company American Exchange Group for $39 million, with the latter continuing to operate the Allbirds footwear brand, while the listed company's main body completely divested its footwear business, becoming a shell company to pave the way for the transition to AI. This means that the Allbirds that once focused on eco-friendly footwear has completely withdrawn from the track it has been deeply engaged in for 10 years and chosen a completely unfamiliar hardcore technology path. In fact, Allbirds' dilemma is a microcosm of many consumer brands. In the context of intensified homogeneous competition and weak consumer demand, it is difficult to survive solely relying on product differentiation. The explosion of the AI track has given these struggling enterprises an illusion of overtaking on a curve. But illusion is ultimately an illusion. Crossing from the consumer sector to the AI computing sector is far more difficult than imagined. So why did Allbirds choose AI computing? What exactly is its transformation plan? According to the announcement released by Allbirds, the core direction of its transformation is AI computing infrastructure. The new company will be named NewBird AI, and its core business in the initial stage is purchasing high-performance, low-latency AI computing hardware and providing access services to customers through long-term leasing. Simply put, NewBird AI does not engage in AI algorithm research and development or AI application implementation, but acts as an AI computing leasing provider, targeting the gap in computing demand that cannot be stably met by the spot market and super large-scale cloud service providers. Why choose this niche track? The reason given by Allbirds in the announcement is that the global demand for AI computing from enterprises is unprecedentedly high. The vacancy rate of data centers in North America has dropped to a historical low. The procurement cycle of high-end GPU and other computing hardware has been continuously extended, and many small and medium-sized enterprises and AI developers cannot obtain stable computing support from large cloud service providers, nor can they afford the high-priced computing in the spot market, which has formed an obvious market gap. NewBird AI's positioning is to fill this gap and act as a supplement to computing leasing. To support this transformation, Allbirds simultaneously announced a convertible financing plan of up to $50 million, which is expected to be completed in the second quarter of 2026. All this fund will be used to purchase high-performance GPU hardware, which is also the core initial investment of NewBird AI. In addition, Allbirds also plans to submit to shareholders for consideration the deletion of the statement in the company's articles of association regarding taking environmental protection as the core purpose. This move marks that it has completely abandoned the core narrative of the original brand and completely cut off from the past footwear business. From the perspective of the transformation plan, Allbirds' thinking is very clear, avoiding the fiercely competitive fields such as AI algorithms and applications, focusing on the niche track of computing leasing, and trying to enter the AI market with a light asset, gap-filling model. But there is a core problem here. Computing leasing seems simple, but in fact, it has extremely high thresholds. First, core hardware such as GPUs is in short supply. The $50 million fund is not much in the AI computing field. Compared with CoreWeave's plan to invest $30 to $35 billion and Nebius' plan to invest $16 to $20 billion this year, Allbirds' capital strength is vastly different, and it is likely to be at the back of the queue for scarce chips. Second, computing leasing not only requires hardware procurement capabilities, but also a series of supporting capabilities such as data center layout, high-performance network scheduling, and software ecosystem support, and Allbirds has no experience accumulation in these fields, which is the biggest shortcoming of its transformation. The $50 million startup fund is only a drop in the bucket in the AI computing track. Moreover, Allbirds' transformation is essentially a combination of a shell company plus AI concept. It has no core technology, no talent team, and no customer resources. It only relies on a transformation announcement to achieve a stock price surge. Behind this, it is obviously not because the transformation plan is perfect, but because of the popularity of the AI track and the speculation logic of the capital market. So, what exactly is driving this 550% stock price surge? The surge in Allbirds' stock price is not accidental, but the result of the superposition of three logics: policy trend plus industrial trend plus capital speculation. Let's first look at the first logic. The continuous boom of the global AI track has provided the soil for this stock price carnival. From a global perspective, AI is fully transitioning from money-burning training to profitable inference, and the commercial inflection point has become clear. Since 2026, the explosion of applications such as AI agent has led to an exponential growth in the amount of token consumed per workflow, while the inference cost has been decreasing at a rate of about 10 times per year, which has brought real and measurable income to the AI industry. At the same time, governments around the world are increasing policy support for AI. China has positioned AI as the core engine of new quality productive forces, and the United States and Europe have also introduced relevant policies to promote the development of the AI industry. In this context, any concept related to AI is likely to be pursued by the capital market, and Allbirds transformation has just stepped on this trend. The second logic, short-term capital speculation, is the direct driver of the stock price surge. From the perspective of trading data, the surge in Allbirds stock price is mainly driven by retail investors and hot money. Because Allbirds had a low market value before the transformation, only $21 million, it is a small-cap stock with an easily speculable stock price. Once the AI transformation concept appeared, a large number of retail investors and hot money poured in, driving the stock price to rise rapidly. At the same time, although institutional funds did not intervene on a large scale, they did not sell significantly, which supported the stock price rise to a certain extent. Allbirds stock price fluctuation is a typical concept-driven speculation. From the perspective of valuation, the transformed NewBird AI has not yet generated any revenue or clear profit expectations, but its market value has soared to $148 million, with a seriously overvalued valuation. This speculation logic is the same as the logic that many struggling enterprises announced their layout in AI and their stock prices soared after ChatGPT ignited the AI boom in 2022. The capital market's fanaticism for AI concepts makes investors often ignore the actual capabilities of enterprises and only focus on whether they are related to AI. In addition, Allbirds' transformation plan is still subject to shareholder approval, and the shareholders' meeting on May 18 will directly determine whether the transformation can proceed. This uncertainty has instead become a chip for hot money speculation. The third logic, the demonstration effect of similar transformation cases, has further amplified market expectations. In recent years, more and more traditional enterprises have chosen to cross-border transform to AI, including many successful cases. For example, in April 2026, Aoni Electronics announced its transformation to the AI inference computing track and launched its own brand AI workstations. With actual product landing and fundamental improvement, its stock price hit a 20% daily limit, and its market value exceeded $10 billion. This successful case has made investors have higher expectations for traditional enterprises transforming to AI, and also made Allbirds' transformation more likely to be recognized by the market. However, it should be noted that Aoni Electronics' transformation has technical accumulation, product landing, and production capacity support. While Allbirds' transformation is still at the announcement level, there is an essential difference between the two. In summary, the surge in Allbirds' stock price is essentially the result of trend plus speculation. The high popularity of the AI track provides the market foundation for it, the attribute of small-cap stock provides the speculation space for it, the demonstration effect of similar cases further pushes up market expectations. But we must clearly realize that such a stock price surge without fundamental support is often a short-term carnival, with huge risks hidden behind it. So, what insurmountable obstacles does Allbirds face in its transformation? How long can this stock price carnival last? Despite the fanatical stock price performance, Allbirds' transformation path is full of thorns. We have sorted out 4 core risks, which are likely to become the straw that breaks this cross-border gamble. Risk 1 is the insufficient funds to support computing layout. The AI computing field is a capital-intensive industry that requires continuous huge capital investment. As we mentioned earlier, Allbirds plans to obtain $50 million through financing to purchase GPU hardware, but this fund is only a starting fund in the AI computing field. Currently, the global GPU market is in short supply, and NVIDIA's high-end GPUs are even hard to find, with procurement costs remaining high. The number of GPUs that can be purchased with $50 million is limited, making it difficult to form large-scale computing supply capacity. In addition to hardware procurement, data center leasing, network construction, talent recruitment, etc., all require a lot of funds. After Allbirds divested its footwear business, it no longer has a stable source of revenue, and subsequent capital supply will become a huge problem. Once the financing is less than expected or the funds are consumed too quickly, NewBird AI's business will be difficult to advance. And risk 2 is blank technology and talent. Lack of core competitiveness. The field of AI computing infrastructure requires not only funds, but also core technologies and professional talents. As a footwear enterprise, Allbirds has no technical accumulation in AI, computing, data centers and other fields, nor does it have a relevant talent team. Computing leasing seems simple, but in fact, it requires mastering a series of core technologies such as high-performance network scheduling, computing resource optimization, and software ecosystem adaptation. These technologies cannot be mastered in a short time, nor can they be solved by purchasing hardware. In addition, there is a huge talent gap in the AI industry, and the salaries of high-end computing engineers, data center operation and maintenance personnel are extremely high. Whether Allbirds can attract relevant talents is also a huge question. Without technical and talent support, NewBird AI is likely to become a simple middleman that buys hardware and rents computing power, making it difficult to form differentiated competitiveness and eventually being eliminated by the market. And the third risk is fierce industry competition and narrow living space. Although the AI computing track has broad prospects, the competition has entered a white-hot stage. Currently, the global AI computing market is mainly occupied by three major forces. First, super large-scale cloud service providers such as Amazon AWS, Microsoft Azure, and Google Cloud, which occupy most of the market share with their strong capital and technical strength. Second, professional computing service providers such as CoreWeave and Nebius, which focus on the AI computing field and have formed a certain scale and customer base. Third, hardware manufacturers such as NVIDIA, which are deeply involved in the computing market by providing GPU hardware and related software services. In contrast, as a cross-border novice, NewBird AI has insufficient funds, weak technology, and lack of customer resources. It is extremely difficult to survive in the gap between these giants. More importantly, the 15% computing gap it targets, although existing, also faces competition from many small and medium-sized computing service providers. It is not easy to seize market share. Risk for need to be known is high transformation uncertainty. Shareholder voting as a key variable. Allbirds' transformation plan is still in the announcement stage and needs to be approved by shareholders at the general meeting on May 18. This is a crucial threshold for the transformation. If the shareholders reject the transformation plan, Allbirds, which has divested its footwear business, will become a shell company with no core business, and its stock price is likely to plummet sharply, returning to the level before the transformation. Even if the transformation plan is approved, there are still many uncertainties in the subsequent implementation process, whether the financing can be completed as scheduled, whether the GPU hardware can be purchased smoothly, whether professional talents can be recruited, and whether customers can be developed. Any link going wrong may lead to the failure of the transformation. In addition, the U.S. Securities and Exchange Commission, SEC, has been strengthening the supervision of concept speculation in recent years. If Allbirds is deemed to be hyping AI concepts without actual business layout, it may face regulatory investigations, which will also bring huge risks to the company. From an investment perspective, Allbirds' current stock price has completely deviated from its intrinsic value. It is a typical story-driven speculation. For investors, especially retail investors, it is extremely risky to chase the rise at this time. Once the market sentiment cools down, or the transformation progress is less than expected, the stock price is likely to experience a sharp correction, and investors may face huge losses. In contrast, those enterprises that have actual technical accumulation, product landing, and clear profit models in the AI field are more worthy of long-term attention. The capital market will eventually return to rationality, and only enterprises with real core competitiveness can stand the test of time. Allbirds' cross-border transformation is not an isolated case. In recent years, more and more traditional enterprises have tried to break through by transforming to the AI field, but the results have been mixed. Let's take two typical cases for comparison to see what enlightenment Allbirds' transformation can bring us. The first case is Aoni Electronics, which we mentioned earlier. Before the transformation, Aoni Electronics was mainly engaged in the R&D and production of audiovisual equipment. In 2025, it began to lay out the AI computing track, focusing on the AI inference computing field, and launched its own brand AI workstations and computing leasing services. Unlike Allbirds, Aoni Electronics had a certain technical foundation in hardware R&D and manufacturing before the transformation, and quickly established a professional talent team by recruiting senior engineers in the AI computing field. At the same time, it signed cooperation agreements with many AI startups to ensure stable customer sources. After the transformation, Aoni Electronics' revenue increased by 35% in the first quarter of 2026, and its stock price has maintained a stable upward trend, which is a successful case of cross-border transformation. The second case is a traditional manufacturing enterprise that tried to transform to AI in 2024. The enterprise originally engaged in the production of auto parts, and announced that it would invest $100 million to lay out the AI application field, but it had no technical accumulation, no talent team, and no clear business plan. It only released a few concept announcements and did not carry out any actual business layout. As a result, its stock price soared by 300% in the short term, but then plummeted by 80% after the market found that it had no actual layout, and the enterprise eventually fell into bankruptcy. This case also warns us that blind transformation without actual support can only lead to a tragic end. The key to the success of cross-border transformation lies in whether the enterprise has the matching resources and capabilities. For traditional enterprises, if they want to transform to the AI field, they must first clarify their own advantages and positioning, not blindly follow the trend. If there is no technical accumulation, they can choose to cooperate with professional enterprises to make up for their shortcomings. If there is no capital support, they should avoid entering capital-intensive tracks such as AI computing. Allbirds' mistake is that it completely abandoned its original business without any preparation, and chose a track with extremely high thresholds, which is equivalent to starting from scratch in a completely unfamiliar field. This kind of radical transformation is full of risks, and the probability of success is extremely low. Cross-border transformation is not a shortcut to get out of trouble, but a difficult battle that requires careful planning and solid preparation. Allbirds' transformation has attracted widespread attention from the market, not only because of the huge stock price surge, but also because it reflects the confusion and attempt of many traditional enterprises in the context of industrial upgrading. But we must remember that the capital market is not a game of storytelling, and only enterprises that can truly create value can gain long-term recognition. Looking back at Allbirds' cross-border gamble from eco-friendly footwear to AI computing, we can see that the 550% stock price surge is a combination of market trends, capital speculation, and other factors, but it cannot cover up the huge risks in its transformation. From insufficient funds and blank technology to fierce competition and high uncertainty, every link is a test for Allbirds. For the AI industry, Allbirds' transformation is a microcosm of the current market enthusiasm. The rapid development of AI has brought huge opportunities, but it has also spawned a lot of concept speculation. We should see that the core of the AI industry's development is technology and innovation, not just sticking to the concept. Only enterprises that focus on R&D and product landing can benefit from the industry's development dividends. For investors, we must remain rational and avoid being led by market sentiment. Please subscribe my channel if you like the content. The stock price surge driven by concepts is often unsustainable. When facing enterprises with cross-border transformation concepts, we should carefully analyze their transformation plans, technical strength, capital status, and other core factors, and not blindly chase the rise. Remember, high returns are always accompanied by high risks, and rational investment is the key to avoiding losses. That's all for today's Market Meridian. Allbirds' transformation journey is still ongoing, and we will continue to pay attention to its latest developments. Whether this cross-border gamble can succeed, let's wait and see. Finally, remind all investors again, the market is risky, and investment needs to be cautious. Thank you for watching, and we will see you next time.